Okay, so we're going to talk risk management. Basically, how do you not be a retard and blow up your account? I know you're gonna. We all are. We're all retarded one day. One, you're going to try something called martingale one day where you just keep adding to a loser. And it's going to feel like an amazing thing. 99% of the time, you're going to make money, but eventually you're going to blow up your account completely. That's really going to suck. So please don't do that. Another thing is you're going to be risking way too much. You're going to be gambling. You're going to be risking too little. You know, there's a lot of things that you can do wrong. You're going to be entering shit you shouldn't be entering in on. You're going to be cutting trades off too early. Let's just dive into it. Super simple stuff. Risk management. As you're going to hear a lot, risk 2% per trade, risk 1% per trade. What does that mean? It means if you have $1,000, you're going to be risking $20 per trade, basically, right? And that's going to be allowing you to manage your trade correctly. I'm going to break it down. It's stupid advice. It's dumb advice. And not dumb in the good way where we're like to promote being dumb. It's dumb advice because what people say is, hey, this level is going to be a 2% loss, okay? And you're going to place your stop loss there. It's not very good advice because you need to be able to be reactive and adaptive. There is an area that you do want to be getting out on, and you could say that, like, you know, we don't want tight stops. We don't want like dumb things like this. Risk management with tight stops. A lot of people talk about that, you know, have a really tight stop and then you're going to win. No, it's super easy to get stopped out. The best risk management is place a small amount per trade and then see how you react off of it, okay? If you end up start to lose, you know, $20 and that makes you feel bad, good. That's a good amount of risk management for a trade to lose. You're going to have an area in which you don't want price to go down to, okay? Where you're going to get out at, okay? You can place hard set stops. It's perfectly fine as long as they're not like super close to your entry, because it's super easy to get these wicks that we were talking about in the last lesson where you kind of just get wicked out and then it still goes in your direction anyways. So that's poor risk management is what people are actually promoting. They might say, hey, I want it to bounce off this level, you know, and I'm going to have a really tight stop. No, what's going to happen is you're going to get eaten up by commissions because you're going to enter, it's going to stop you out. And then you're going to enter again, it's going to stop you out. You're going to enter again, it's going to stop you out. And eventually you're going to make that trade, but you're going to have spent so much in commissions getting in and out that you're going to get eaten away. So the best risk management is actually to be kind of just simple with it and do something like this. So have the wider stop. Let's say this is your trade, you're trying to enter here. Have the wider stop loss so that you can still manage the trade. Sometimes you're going to get out of it. Like let's say it's really showing strong pressure to the downside, strong closes to the downside. It just doesn't look good. There's no pickup in momentum going in the other direction at all when it does hit your level, okay? Well, then sure, I'm going to get out of the trade earlier and I'm going to manage my risk, okay? Manage it so I don't have to take that full sort of 2%, you know, whatever it is. You could say it's 5%, something like this, you know. There's no hard set amount that you want to be risking. But the reality is if you're risking like 10% per trade and you go on 5 losers in a row, you just lost 50% of your capital, you know what I mean? So be mindful of how much you're risking. Allow yourself to, you know, sit in a trade, be in drawdown meaning in a losing trade, and be comfortable with it, but a little bit of pain. That's the my ideal amount that you should be losing. So if $100 is a lot for you to lose in a day, don't risk that much per trade. Risk like $10 per trade, you know what I mean? Because then you could take a couple trades, lose, and then be down $30 and it's not a big deal for you, okay? The whole goal of this is to trade in a manner that you lose a lot, you know, a high portion of your trades, and you're comfortable with that. Risk management allows you to go on losing streaks and still be comfortable and trade the same way mentally despite just being on a losing streak. So you do need to make it a small enough percentage that it's not a big deal for you. There's another notion to risk management is, okay, how long do I, like the opposite direction? If I'm in profit, that's also kind of risk management. It's more, we're talking like capital management. And if I'm in profit, you know, it turns out that like, okay, my target was here and it goes all the way up to here, and then it shows very clear signs that it's pulling back, you know, it might be a good idea just to cut that trade, because the reality is you're in trade management at this point, not risk management. Let's say this was your target and this is your stop loss. Well, as the trade develops and gets closer, that position is not this position anymore. It's becoming this. You can always lose. So you could move your stop loss forward and still be having proper risk management. So this is what you ideally do as a trade develops, is you are always in a new trade. Does that make sense? I'll say that again. You are always in a new trade. So every single time you get a new candle, okay, boom, it's moved forward. this is your new trade now. Do you still want to be in this position? Does it still look like you're going to hit that target? Yes. Okay, sure. Okay, next candle develops. Okay, do we still want to be in that position? Well, I might say, hey, it might be wise for him to move that stop forward, okay? Because I still think that's an ideal position for me to be in, okay? Next, we get up here, and it gets super, super close, and it starts coming against us. Well, it probably wise for me to say, hey, I'm going to set up a new idea in my head that if it comes back down here, I'm going to get out, because I don't want to be in a loss after all of that. So you're going to react to the chart as it moves forward. The reality though is, guys, I'm going to tell you this now, it's probably easier when you're starting to not touch the trade at all, okay? But I'm just putting that in your heads so that you can understand, hey, you know, this is something I might need to do in the future. As trends progress and develop into new things, you're going to be able to be more reactive and be better at trading. That's it for risk management.